All right, we're going to get started. This is a look at the U.S. 10-year Treasury. It's up a lot. You can see from this chart here that we've been going down. The yield for the 10-year Treasury has been going down until today. And you can see the appreciation of the S&P as the yield goes down. Today we had a switch where we had a good jobs report, which said the economy's doing pretty good. And that made the S&P go down. Let's look at the S&P. It's going down a little bit. So the inverse correlation of the S&P with the 10-year continues. All right, so let's look at some more things that are going on today. Let's look at the price of oil. Price of oil is $75 a barrel. It has not changed today at all. And let's look at the sector ETFs. Sector ETFs. Okay, so the ones down the most are, let's see. Okay. Down the most are gold miners. That is pretty amazing. They're down 7%. That is pretty outrageous. I'm not sure exactly why. In a new tab, let's go to see look at the dollar. Um, the US dollar has been appreciating recently. It's up again today. So, all right, that would explain a little bit of that move. Okay, so let's look at some more things that are happening. The S&P is overextended. We're around 86, so we're overbought right now. And let's look at some of the other sectors. That is amazing. Gold miners are down 7%. Let's look at some of the other sectors. Home construction ETF down 2%. Okay, so we had the 10-year going up. We expect any sectors that are sensitive to interest rates to go down. So as the interest rates go up, the demand for housing goes down because people have to pay more on their mortgages. So that makes sense why the home construction is down. As the interest rates go up, anything that's high yielding will be in less demand. So that explains why telecom ETF, home builder ETF. Okay, that explains. This is all an interest rate reason why these are going down. Utilities are down too because of that same reason. The things that are going up the most, financials, oil, industrial, healthcare, very conservative sectors, and energy. All right. So we have our theme for today, and it's all based around 10-year, it seems. So we are overbought in the S&P right now. You can see it. We've had a lot of interest in NVIDIA that's splitting today. It's splitting 10 for 1 at the end of today. So we'll go over a little bit of that later on. Okay. Okay, so June is traditionally it's a flat month. So it's not a very good month, seasonality wise. We're getting into the summer months, which August, September are bad months, and June is a bad month. So right now we're overbought. So that leads me to believe that this is probably going to be a time in June where we're going to have some um, stock market going down for a little bit. We have the Fed meeting in the 11th and 12th, and we have a holiday, a newer holiday. So people might not be as excited about and apprehensive about this. July 4th, we always have a good rally around that day. That's why I have green for the month of July. All right, and let's look at some of our talking points. We had a rally in the S&P up 1.5% until today. And we had the 2-year and the 10-year yields go down 4%. So that's a pretty much a one-to-one correlation. As the 10-year, 2-year goes down, the S&P goes up. We had a hot job report today, so that made the yield go up on the treasuries. So it's just other things we're keeping track of. We're losing momentum in the number of stocks in the S&P above the 50-day moving average, above the 200-day moving average. So we're losing momentum going into the summer season. So it doesn't look like we're going to be appreciating. It looks like the only things that are carrying the stock market right now are the big tech stocks. And let me see, we have less activity in the summertime, and people are not as excited about buying because there's not a whole lot of earnings coming out until 3 months from now. Okay, so we can see from the S&P where we're basically right in the middle of our trend lines. We're at the top of our stochastics. So it's a very good chance we're going to be bouncing off the low here pretty soon when we get into June. So a lot of people are selling calls, and they're either selling some of their positions so that they can buy it back later on in the month. So we're overbought. As you can see, in the last week, we had a really big move downward in the yield for the 10-year. And you can see the S&P went up as that inverse correlation continues. You can see that as the yield goes up, the amount people are willing to pay for S&P goes down. Same thing with the 2-year. All right, so let's look at some of the major variables in the stock market. You can see the price of oil is going down. There's a lot of indications that the global economy is weakening, with the price of oil as the price of oil goes down, that's an indication that there's less activity or in the world, less economic activity. So we have a lot, and the U.S. dollar is going up. So today went up a little bit, but it's been going up over time, indicating that the price of commodities will go down. So let me see. Let's look at so you can see the dollar is going up. It's in an uptrend here. And that's not that great for multinational stocks. For instance, the Googles, the Microsofts, the Facebooks that are doing business overseas, and the Procter and Gamble's. A stronger U.S. dollar helps reduce commodity prices, such as gold, but it also has a problem where it reduces the amount that multinationals make. So we're watching that. And that's probably why some of the gold miners and gold and other related commodities are going down, because the dollar is going up. All right, fear and greed index, we're getting to fear territory now. It was neutral last week, and we're getting more fearful as we have less confidence in the stock market, and we're getting into some of the worst times of the year for stocks. We're going to have some more fear involved. So we're getting more towards a time where you can start buying, but not right now. Okay, contrary indicator, we have more bulls than bears in the AAII survey. So that's a contrary indicator. So um, right now let me see what else is happening here. In the VIX, we have a 12. So we don't have, we have 14 now. It was 12 last week. So we're starting to get fear into the market, but not a whole lot. So right here is our emotional gauge. We're not capitulating right now, but we're starting to get fearful. We don't have earnings right now to help the stocks, and all we have is government reports. So we had some scares about let me see where commercial real estate defaults this week. So we have that as a possibility of a problem making the stock market go down. We'll explain that later on. Let me see. For our worst to first, our utilities are still doing good. Consumer staples are doing good. These are all sectors that did bad last year. They're doing good this year. But we do have IT and communication services as the best performing sectors this year, as they were last year. AI and um, weight loss drugs are still two of the themes that are carrying this market this year. We have some subsectors that are doing good because of AI, build out of data centers, the electricity demand, need to secure the grid with the cyber security and utilities. So we're going to keep an eye on those sectors right now. So you can see the best, yeah, the best sectors this year, IT, and the communication sector, which are communication services sector are Google, Microsoft, no, Facebook, a lot of the big tech companies. All right, so let's look at some of the sectors that are doing good this year and bad right now. We already looked at that. Let's look at some of the stocks doing good and bad. It's taking a while to get that, so we'll come back to that later on. I'll refresh this while we're talking about other things. Oh, look at that. It popped up. All right, so we have Las Vegas Sands, Air Product and Chemicals. Okay, so we have a lot of, okay, we have some drug companies doing okay today. We have Abbott Laboratories. We have a lot of industrial companies, companies that are cyclical, companies that are conglomerates. We have 3M, we have GE Veranova, we have IP International Paper. Okay, these are all companies that are do good when the economy is doing good. So we had a good jobs report that indicated that the economy is doing good. That's probably why a lot of these are doing good. Ones doing the worst are, okay, we have Sherwin-Williams. They're like almost a direct correlation to how the housing market's going. So as people are painting more houses, they're going to have more business. But right now we had high interest rates, so higher interest rates on the 10-year. That means that demand for housing goes down. So that would explain that. Um, All right, I'm not sure exactly. Okay, Enphase Energy. Maybe as the demand for housing goes down, you have less demand for solar on the top of houses. Um, Newmont Company, Freeport McMoran. Okay, so maybe the Freeport McMoran's a copper company, so copper could be in demand with housing. So this could be like a interest rate story again. Let's look at the NASDAQ, the things that are doing the best and the worst. Cybersecurity, one of our themes for this year. We have CrowdStrike, Palo Alto, um, Zscaler. They're all doing pretty good today. Um, what other things do we get from this? All right, that's all we can get from that. Adobe, I'm not sure why it's up. Um, one's going down the most. We have a lot of drug stocks. We have Moderna, Biogen, um, let me see, Qualcomm. Okay, we have some semiconductors in the bottom half here. Global Foundries, they do um, semiconductors. We have Qualcomm, semiconductor, KLA, Tencor. They're a semiconductor related company, and A Analog Devices. Okay, not sure why that's down a lot, but that's the theme, and I think that's all we can get from this today. Okay, let's go back to our talking points. Um, Amazon and Meta continue to do really well this year. Um, but XBI, the biotech ETF, and KWEB, they're still not the worst performers of his list. Got picked out a couple charts that were interesting. We have uranium ETF. It is oversold and it's at the bottom of its trading range. So this is a good time to buy this if you're interested in an ETF tracking uranium. And uranium is actually going to be um, in demand because we have a need for clean energy around the world. And that's one of the themes. And of course, AI data centers are going to be requiring a lot of energy. So that's an interesting chart. Yeah, gold actually um, is down with the dollar being up. So it's at the bottom of its channel and it's oversold. And XLB, the material sector ETF, is also down at the bottom of its range and it's oversold. Amazon continues to be one of the best performing stocks this year, and it is in an uptrend. It's near its low. We were talking about this last week. Um, and okay, so we had a story from Moody's. They cut 6 U.S. banks on commercial real estate exposure. So this is the beginning of it's called a canary in the coal mine. Whenever we know we were talking about this being a possible issue earlier this year, where banks have a lot of bad loans to commercial real estate. We have work from home and companies that don't have office space need office space anymore. So that's going to cause a problem with banks that lent to these kind of commercial real estate ventures. So that could cause a market meltdown, and we're keeping an eye on that. This is just another example where we have some banks that could go under because of this. Um, But whenever you're investing for the long term, like me, you have to say, well, how does this affect all the stocks that I have in my portfolio? And if they have a minimum effect, then you have to ignore this if we have a meltdown in the stock market because of this. Um, we had a NVIDIA 10-for-1 split at the end of today. A lot of people bought NVIDIA into this um, news, but be ready for buy on the rumor, sell on the news. Um, So as the Nvidia stock rallies, it could have a swift reversal over the coming weeks because if it's just an idea where if a news is expected, a lot of times whenever the stock rallies into the news, after it happens, it people sell the stock. So be ready for that. And also we have the CEO of the company selling some of its stock also, and that's an indication that it might go down some more. Okay, so today there was an economic piece of news. There was a better than expected job report. So our formula is better than expected jobs added equals strong economy. Strong economy, rate hikes or no rate reductions. That's bad for stocks. This week, Bank of Canada and ECB cut rates. That makes the US dollar stronger. All right, so whenever the US dollar is stronger, commodity prices go down. That's why probably gold is going down today, and all the materials are going down. And that'll cause deflation. That means the companies can make products in America for less money if it costs less to make those products. If we get, for instance, um, aluminum for less than it costs less to make our cars, for instance, or airplanes. So if the dollar is stronger, then multinational profits go down. So if there's a stock like Facebook that gets half their money from overseas, then they don't make as much money if the dollar is stronger. So that we have to keep that in mind too. So it's a double-edged sword, the US dollar. I did a screen with Fidelity. I thought it'd be interesting to go over some of the um, stocks that were in the screen. What I did was I highlighted some of the most promising parts of the screen. The most important I thought was PEG ratio. So you can see the PEG ratio of less than 1 I have in red, and every other whenever I saw an interesting combination of red and yellow, which is good numbers, I highlighted them. And you can see Airbnb, we have TSM. A lot of these stocks are larger stocks, and I sorted by market cap too. So these are all larger companies. And I thought it'd be interesting to go through some of these new stocks I found in my stock screen. The first thought would be we went over this stock before, Taiwan Semiconductor. This you can see that its forward EPS is 21, 25, a lot of 20s in there. So they're growing around 20%, and their PEG ratio is 1.8. So that combination is pretty good. I thought it'd be we actually went through this last year. We were wondering what would do better, Taiwan Semiconductor or Intel. And at the time we said Taiwan Semiconductor because they have a lot more diversity. They're actually manufacturing for other companies as a global foundry kind of company. Um, and Intel, they were kind of behind the times and they were losing market share to AMD. And so now we see after that time period that Intel is actually going down and Taiwan Semiconductor has been going up. So Taiwan Semiconductor was the best pick to make at that time. So we can see that Taiwan Semiconductor is growing around 20% a year. Their PE is 31, so their PEG ratio is 1.5. So they're still 1.5 times overvalued. The good thing is they have customers such as NVIDIA and a lot of the big tech companies. And they do a lot of they make about 20% of the world's semiconductors. So they're a very important company. Bad part is China might invade Taiwan and take over the company, and you might lose your whole investment or something along those lines. So that could be why they're not demanding a more of a premium. So we look at their statistics. Taiwan Semiconductor, they have a profit margin of 38%, which is really good. Return on equity is 25, and that's good too. Their PEG ratio is 1.8 according to Yahoo Finance. So it's all matches things we would like in an investment. Right now, I'm not invested in this because I'm afraid China might invade Taiwan, and then you lose your whole investment if that happens. Most of their process manufacturing is in Taiwan. They're trying to diversify into America and a couple other countries, but that isn't really happening. So The other stock I have in our top list here, we have Eli Lilly, and according their forward EPS from last year to this year is 62%. Return on equity is 53. All these numbers are off the really good. So let's look at that company again. It seems like they're growing around 30% a year. Their PE is 60, forward PE. So they're 2 times overvalued, but they have more demand for their weight loss drug than they can make. So that is a really good situation, and they're making more, they're building factories to make more of the products. So that is, and then they have an Alzheimer's drug that's coming around the bend, perhaps. So these are all making the stock go up a lot. You can see that the profit margin is 17%, return on equity is 50%. So those are all really good. And they're around 2.5 times overvalued according to Yahoo Finance. So that kind of matches our expectations. I have another story that came up this week, GameStop. There's a guy that's pumping the stock. It's basically a worthless stock. And it's making the price go up and down a lot. There's a big temptation to buy it and ride it up on momentum. And you have to ignore this kind of thing because when you look at the fundamentals, the stock is worthless. The business model is worthless. It's it's a an issue where you're playing musical chairs and you don't want to be stuck without a chair at the end of this song. So these stocks are this guy's buying, this to pump it up. He's selling it, and you're stuck with it as it goes down. So try to avoid these kind of situations. Warren Buffett wouldn't buy this, so I wouldn't buy it. Um, yeah, that was a good little exercise. Every once a month or so, I like to go over some of the rules that I have for investing. One of the rules, I look at charts and I try to buy and sell at the right time. This might save you a percent or two. Um, Sometimes it works, sometimes it doesn't. But whenever a stock is in an uptrend, as in this example of this S&P, you try to buy a stock when it's at the bottom of its range, and you draw a line at the top of a chart and at the bottom of the chart. And this only works if the stock is going an uptrend. You try to buy it when its stochastics are near 10 or lower, and you sell it or don't buy it whenever it's at the top of its range, or if the stochastics are at 90 or higher. Okay, so and we usually like to wait for extreme fear or fear to buy, and that's why we keep track of the fear greed index. Okay, and you try to balance out your sectors into different categories so that whenever one sector goes up, another sector will go down. And that kind of helps you in the long run to be diversified. These are the ratios that I look for, the metrics, whenever I'm doing my stock screens. I want to return on equity greater than or equal to 12. I like to have total debt low. The profit margin greater than 12. Market cap, I like to have a larger market cap greater than 50 billion. And the forward PE, low compared to the growth rate. And I like to have a growth rate of greater than 10. And a PEG ratio, try to buy it around a 1. In quality companies, you might have to go up to a 2 or something like that to get a really good company. But whenever I look at the E-Trade earnings versus stock chart, I buy a stock that's going up. Their earnings estimates are going up and in a straight line. And I always divide out the years. I divide this number by that number. That tells me the growth rate. And we just did that as an exercise earlier in this talk. And I try to have it to where it's growing at least 10% in the coming years. So that's a little explanation. And also, you want to have a highly transparent and predictable earning streams, and good management. That's kind of intangible. You have to study the company and um, to really understand that. And you try to have a company with a competitive edge too. For instance, we're looking at some of our stocks are waste management. It's really hard to get into the waste business. They don't give permits anymore. And, there's only two companies that are doing that. And that's an example of a competitive edge. Um, Cancel. All right. So I think I ran out of time. All right. Well, thank you very much for attending. I think that was an awesome little presentation. If I can answer any questions for you, let me know. And I hope you have a good week of investing. That's about it for now. All right. We'll talk to you later.